The global economic crisis of 2008 appears to have stabilized into a wicked worldwide recession. But many investors are still reeling from credit crunch to stock market sell-off. What happened, and where does one look for a reliable rate of return these days? Well, Tim Davis is back with us. He's the bond guru at Hefren-Tillotson, sponsor of our Regions Business. And welcome. Good to see you again.
Good to see you. Thank you.
Yeah, what a wild ride it must have been since it's been just last September in your world.
In the world of municipal bonds, it actually started in February, but it culminated in almost that perfect storm scenario in September when AIG and Lehman Brothers defaulted and filed for bankruptcy. And that's just split the world markets into pieces.
And so much attention, of course, paid to equities, the Dow, the stock market sell-off, and all the rest, but it was every bit as tumultuous in the fixed income world.
It was. When that crisis happened, and we were in the middle of a credit crunch and credit crisis at the time, and when that particular event happened, it drove cash, all available cash, and raised from the sell-off in equities into treasuries. That drove treasury yields down to just over 2%. From around 4.5%.
At one point, it was almost like you had to pay the government to take your money, as I recall.
It was. The T-bills were negative yields, and the yield curve was very, very steep at that time.
Wow.
So while Treasury yields were falling, municipal bond yields were rising because we also had a credit crunch on bond insurers, which were once almost AAA rated, and now they were losing their ratings and being downgraded. People were uncertain about the safety of their holdings. So their yields were rising while Treasury yields are falling, and investors just didn't know where to go.
And you talk about some of the dynamic about the insurance. It seems like in recent decades, and was part of the genesis of what happened, it's like we almost began to entrust the insurers more than we did the underlying assets.
Well, you're exactly right. We really didn't have bond insurance until the mid to late 70s, and then all of a sudden into the late 80s, early 90s, we began to see almost every bond issue insured. 50% nationwide, I think, is the statistic. So the reliance was no longer on the underlying credit, the taxpayers and the revenue payers of waters and sewers and schools. It was on who's insuring my bonds.
So when the insurers go bad, or their ratings go down, all of a sudden you're thinking, I can't hold this stuff anymore, and yet the underlying communities might be hanging in there okay.
Unlike Lehman Brothers, which can go bankrupt and move across the street and reorganize and come back to life, a municipality, a water authority, or a school district, or the city of Pittsburgh can't pack up and leave and reorganize somewhere else. It's geographically bound to its citizenry and its taxpayers. And we had to relearn that. We had to go back into the 70s and calm that down. Meanwhile, you're seeing the value of your municipal bond portfolio erode at a dramatic pace. And that was very, very scary. On the other hand, new investors were taking opportunity in buying the new yields, which were trading at over 200% of the yield of treasuries, which treasuries are taxable yields, municipals are tax-free.
There were some big-name investors who were doing just that, right, late last year, early this year?
There were. You might have heard recently it was reported that Warren Buffett of Berkshire Hathaway had ended June of last year with $2.05 billion in municipal bonds in his portfolio. At the end of December, he had doubled that to over $4 billion.
Extraordinary.
Extraordinary, but it was an extraordinary opportunity because since that time, yields have fallen. The market has stabilized, not completely, but somewhat, and there's been a great deal of return to be made. The municipal market on AAA, the highest credit portion of the municipal bond market, has returned 6.7% so far this year.
Wow, so one of the better performing asset classes through this. Now, with a lot of talk about the stimulus package and what's going on with all of that, is that going to affect the municipal bond market as well?
It's having a great deal of effect right now. It has just really begun. So far in the nation, under the Build America Bonds program of President Obama, we've sold about $14 billion worth of new issue municipal bonds into that program. And that's a taxable bond, but the community that's selling it receives a 35% relief or subsidy on their interest payment, which lowers their overall borrowing costs, which stimulates the economy. Well, these bonds are catching on, and there's some anticipation that we could see 10 times that amount of issuance before the year is over.
Wow, so new investment opportunities there. Only a few seconds left, but I wonder, 40 years of experience in this space, what do you take away from what we just went through? What did you learn out of all of this?
I didn't learn anything, but I had a great deal of fun and opportunity going through it. It's such an unusual time. I doubt we'll ever see that again. It's an anomaly. We have to put that past it, go back to basics, and relearn what we knew in the 70s.
All right, Tim Davis from Hefren-Tillotson, thanks so much.
Thank you very much.
Yeah. And we'll be back in a minute with a little more dollars and cents. Stay with us.